Hello, have you heard about the latest changes and updates in real estate tax laws in Nigeria? If you're just joining us for the first time, this is where we share tax updates and powerful finance insight that help you and your business thrive. So if you're just joining us today for the first time, you can click on the subscribe button, the like button, and turn on your notifications so that you can get subsequent information and insights from this channel. Trust me, powerful insight, powerful insight. So today we are going to be looking at the three major changes in real estate tax laws in Nigeria. There are several conversations about the new tax reform bills and how it will impact the landscape, the business landscape, and the economy of Nigeria. So here is where I'll be discussing with you, and then we'll be having a conversation about the major changes that affect real estate companies operating here in Nigeria. So if you're a real estate company, come closer, your seat, grab your popcorn. Let's get to have this conversation, and trust me, it's going to be a very value-packed and very reasonable conversation. So I'm just going to be discussing three major changes in real estate tax in Nigeria. So let's talk about the first major changes. Value added tax. A lot of people, a lot of real estate companies, especially you watching me right now, have received audit letters, reassessment letters from Federal Inland Revenue Service there, but then one of the provisions in those letters are default on value added tax. Most of the times, real estate companies are slammed with huge VAT penalties for reassessment, and then they end up paying. Of course, most of them end up paying without the knowledge that property based on inference, by inference I mean based on decided cases, are not VAT applicable. For instance, there are properties that are not VAT applicable. Let's look at it this way. When it comes to value added tax, there is actually no particular provision in the tax law as of then based on the old tax law that clearly states that properties are exempted from VAT. But based on the definition in the tax law that states that goods are movable commodity and services are intangible commodity based on the provision of the tax law, then property do not fall into that provision of that definition of goods and the definition of services. And based on that, and based on many decided cases, we on many occasions have helped real estate companies run away from that penalties that relates to value added tax. And of course, this our argument is always admissible in the tax law, and of course with the tax authority to ensure that those real estate companies don't pay value added tax on purchase of property. But then of course, many real estate companies that have not come across us as consultant, or me myself or our companies as very good consultant that can help you sort this out, end up paying huge sums in penalties. But then currently in the current tax law, the new tax reform bill that has been signed by the president, value added tax has been clearly exempted on property. So going forward, I believe you as a real estate company or real estate developer or agent watching me right now in this video will get to have the leverage where value added tax will not be assigned, or of course will not be charged to your company when FIRS writes you a letter or when FIRS come for you. But there are cases where you need the advice of we consultants to help you scale and to help you avoid those penalties. So the second point we are going to be discussing around these three major changes in real estate tax in Nigeria is stamp duty. Let's have a conversation around stamp duty. Prior to this new tax law, right, the old tax law charges stamp duty on property based on graduating rates. When I say graduating rate, I'm saying different rates from one rate to another to another. So let's look at this. Let's take for instance, you offer your property out for lease of not more than 7 years. Based on the old tax law, you are expected to pay 0.78% of the value of that lease. And then if you offer your property out on lease for a period of 7 to 21 years, you, based on the old tax law, are expected to pay 3% of the value of that lease. And then if you offer your property out on lease from 21 years and above, based on the old tax law, you are supposed to pay 6% stamp duty on the lease. But then in the new tax law currently, some things have been restructured, and the government has ensured that these particular provisions of stamp duty do not, of course, affect property owners so much. So stamp duty currently is charged at 10 million naira per month. So if you receive rent, if you are a high value property owner and you receive rent of not less than 10 million naira per month, stamp duty applies to you in the new tax law. And of course, if you are a high network or low network property owner, low net worth, right, I mean low net worth property owner, and then your rent on your property or the lease on your property is less than 10 million naira, of course you are exempted from stamp duty. So these are the structures around stamp duty in the new tax law as relating to real estate companies. So if you are a high net worth property owner that has a property that you give out rent or you lease for an amount not less than 10 million naira monthly, you are going to now be paying stamp duty. But then if you have a property that you lease out for an amount that is less than 10 million naira monthly, you are exempt from stamp duty. And of course, you are not supposed to bother so much about stamp duty. All you need to do is to pay close attention and ensure that at the point where this property value the month gets to not more than 10 million naira, then you start deducting and remitting. So there are two ways. You either transfer the burden to your tenant that is going to lease your property, or you prepare to offset the stamp duty based on the relevant rate in the new tax law. So this is what the new tax law says about stamp duty as relating to real estate in Nigeria. So the third point we are going to make in this video today is the update and clarification of capital gain tax. Capital gain tax, prior to this new tax reform bill, capital gain tax was charged at 10%. But currently, capital gains tax has been qualified or classified as an income tax and is charged at 30%. And of course, the primary dwelling residence of an individual is exempt from capital gains tax. Let's say, for instance, you are an individual that sold your primary dwelling residence, that's your house where you stay, where you live, then that is exempt from capital gain tax. But of course, if this property you are selling is not a primary dwelling residence, you are going to be paying 30% of that amount of you used to sell that property to the government. 30% of the value of the property to the government as capital gain tax. But then, before you get to say, oh, the 30% is too much, let me play a scenario of what happens when it comes to the sale of the property. When you want to sell a property, there are some expenses. Let's take, for instance, you got an agent that help you sell that property. The money the agent will get, or the value you are paying to the agent, will be deducted as allowable expenses from the value of the property. Then, prior to selling the property, if you had marketing expenses to market the product or market the property before it was sold, that expense also can be classified as an allowable expense for the sale of that property, and several other expenses. Then let's take, for instance, you bought the property at 10 million naira and you want to sell it at 100 million naira. That value of that purchase value is also an allowable expense. So when you put together the allowable expense for or before the sale of that property, you are going to claim is reduce that value of those allowable expenses from the total value of that property before you charge the 30% you are going to pay to the government as capital gain. But the top of the conversation here that has to do with capital gain is capital gain now have moved from 10% to 30%. So capital gain now is classified as an income tax and is charged at the same rate as company income tax, which of course is 30%. So if you are selling a property as a developer, as an agent, as a real estate company that is not a primary dwelling residence, have it at the back of your mind that you are owing government 30% of the value of that property, less your allowable expenditures, as I explained earlier. So this is one of the major changes in the real estate tax in Nigeria. The first, we spoke about the value added tax, we spoke about stamp duty, and now we have just spoken about capital gain. So these are the three major changes in the new tax reform bill when it has to do with real estate companies in Nigeria. So thank you for watching this video right now. Thank you for staying with us. You can also subscribe, click on the like button and turn off your notification so that we get to share valuable content. This is just a part one of the videos, and we can of course release the subsequent major changes in real estate tax law as we proceed to study the tax law in depth and bring you valuable information that has to do with real estate tax and of course tax generally in Nigeria. And of course also we bring you powerful financial insights that will help you as an individual and as a company thrive. So if you are watching us and you are a subscriber on this channel, stay glued for powerful insight. Thank you very much and see you in the next one.